Okay, let's go ahead and get started with the next session. Hope the links are working for everyone. So we're going to talk a little bit with Moody's and DBRS Morningstar about some of the metrics that are used thus far in fixed income and in structured finance for ESG investing, what the future of this market holds, their perspectives on how this market is evolving, etc. So let me do some introductions here before we dive in. So I'm joined by Gordon Kerr and Aaron Baker. Gordon Kerr is the head of structured finance research at DBRS Morningstar. Gordon Kerr heads all of the structured finance research, and he publishes commentaries and insights on all aspects of secured investing and keeps the market up to date on issues facing securitization and covered bonds. Gordon heads up the DBRS Morningstar ESG Credit Education Committee, a global project to expand the credit rating agency's thought leadership with regard to ESG issues. Prior to DBRS, Gordon spent 9 years in research and trading at Citi, covering securitized products, covered bonds, and corporate credit. Gordon is a graduate of the School of Business in Toronto, Schulich. Is that right, Gordon? Did I get that right?
That's
Schulich.
correct, yeah.
Sorry, I should practice that. Where he obtained his MBA, he also holds a science degree from Acadia University. We're also joined by Aaron Baker, product strategist, Moody's ESG Solutions Group. Aaron Baker is a product strategist within the recently established Moody's ESG Solutions Group. His focus is the development of new and enhancement of existing sustainable finance product offerings. He has previously worked at both BBVA and Nomura, where he held roles including fixed income research and syndication origination within sustainable finance capital markets. Additionally, he has founded a social impact enterprise focused on corporate mental health. Also need to flag that for Aaron, he is not representing the views of Moody's Investor Service or Moody's Investor Services, but rather Moody's ESG Solutions Group, which includes their subsidiary VE. So thank you both Aaron and Gordon for joining us today.
Thank you.
Thanks. Nice to be had.
So let's dive in. Gordon, I'll start this one with you. Continuing challenge in ESG has been these definitions around ESG and sustainable investing. I believe you define it. Your firm defines strategy as sustainable investment if it is described as focusing on sustainability, impact, or environmental, social, and governance factors in its prospectus or other regulatory filing. Could you walk us through a little bit of how that works and what that definition means, what clarity you think the market is evolving to try and establish, et cetera?
Yeah, so I think there's in terms of DBRS Morningstar, there's a slight distinction. We've just recently published a criteria outlining how we are looking at ESG factors in our credit ratings business. And we've gone through and assessed and come up with 17 different risk factors that we see across both environmental, social, and governance. And then we've taken it from a global approach. So we are not just looking at structured finance or corporates individually. We're taking it across the entire ratings business. And then within each of those different asset classes, corporates, FIG, sovereign, structured finance, they may or may not incorporate all of those 17 different risk factors in their views. And what we've done is we've published this criteria or request for comments with regards to the criteria to soon to be published. And we set out how we look at each of these different risk factors and the way that they could potentially be a part of a credit rating or have an influence on a credit rating that ultimately can impact significantly on a rating. And then we are looking to disclose where those do have a significant impact on a credit evaluation in that rating assessment.
And so it's pardon the elementary question, but it's directly impacting the rating. Is that could you put some color?
I mean, potentially, it doesn't necessarily. So it doesn't always impact the rating. So we may have a discussion about ESG factors in a committee. The end result may be that there is no influence on the actual credit evaluation. But what we've done is we've set out to highlight where it does have a significant impact on a credit rating, that we will then disclose that to the market.
Interesting. Are there some examples you can share of places where this has taken place?
Well, we've just literally just launched the criteria, so there's not. We have. Having said that, though, we have done some disclosures. So there has been a couple of places where there have been has been an influence. We recently wrote about, for example, in the Netherlands, there's a something called there's a guarantee scheme on housing and mortgages called the NHG. And there we determined that there was a significant social impact through its maintenance of the housing stock. So there are some requirements in that guarantee scheme in terms of maintaining the housing stock and incorporating some of the mortgage borrowing into environmental upgrades.
The Dutch are leading the way on some of these things. Then we'll try and learn. Aaron, how about your firm's perspective on the definitions and how you guys look at this stuff? Any introductory remarks would be great.
Yeah, sure. So Moody's ESG Solutions Group covers or encompasses both the VE or Vigeo Eiris ESG rating agency, which we have a majority stake in, as well as 427, which is effectively a company which focuses on physical risks, particularly with relation to wildfire and flooding and things like this. In terms of how we look at it as a solution, one of the big challenges that we noticed, at least around ESG ratings and things like this, are predominantly in relation to there is an issue with transparency and also predictability of those scores. And so what we're looking at doing is seeing to what extent this is a data question. So firstly, is the data comparable? Can it be standardized, and can it be fed into investors as well as issuers? And then what they can do with that at the other end. And of course, at the moment, there is a proliferation of ESG data. The correlation between ESG rating agencies is nothing like the credit rating agencies. Now, we could say that that's a good thing as well, because of course they're measuring different things, but ultimately, because methodologies aren't always transparent across that market, the idea is we're looking at how to make that a little bit more transparent so that they can be used interchangeably.
Yeah, obviously we keep coming back to this challenge of figuring out what metrics and definitions to share so that these things can converge in some level. I mean, we're not going to all agree on everything. There should be some secret sauce, I guess, at each firm, but clearly there's quite a wide schism to sort of traverse at this point in this market. Is ESG and sustainable investing, do you guys think of these things as the exact same thing, or while we're talking about terms, or are they interchangeable terms? Are there differences? How do you think about ESG versus sustainable investing as terminology?
I mean, in terms of from our perspective, we will look at, we will have, let's say, client segments of investors where we'll say ultimately sustainable investing for us is where the investment process is influenced by ESG factors. We would consider that. So in that sense, it can be used interchangeably. ESG factors, of course, I mean, Gordon mentioned the 17, VE has 38 different criteria. Not all are applied to different sectors and things like this. And of course, let's say some ESG factors are financially material, which is very much, the rating agency approach. And then others are looking at also at stakeholder approaches. So VE, for example, looks at a combination of financial materiality for the company, but also stakeholders in relation to, for example, which is a more of a combined risk and values driven analysis. And again, this is something that we see. We look at it interchangeably as a segment, albeit we will deal with the different segments within that. We would parse out the different segments and look at it values driven versus risk driven.
That makes sense. But you guys both similar in that?
For us, we've taken the we've focused on the ESG, so we've approached it from the environmental, social, and governance side of things. Sustainability, though, it really depends on who you talk to be perfectly honest with you. There are some people that would distinguish between sustainable and ESG investing, and there are others that would use it as interchangeable. You do have, for example, if we look at the fixed income market, you have green bonds, you have sustainable bonds, you have social bonds. So you have, there are all different types of strategies, I guess, the best way to approach it, in terms of climate as the whole, which is what no, even ESG, you're not looking at just climate. So it's, it really, it can get to be a complex question. But I would think in terms of the overarching view of things, sustainability and ESG tend to be relatively interchangeable from the markets.
Yeah, so that makes sense. So maybe sounds like it's the answer, but largely, largely they're pretty overlapping. This raises a different question, and you kind of, kind of parsing off your last comment. So there's E, S, and G. To be a sustainable investment, how do you guys, or how your firms, or how do you think this market evolution will look at the differences between these three and the interplay between these three segments? Do you need to be all ES and G in order to be deemed sustainable, or is it sufficient to be very good in one, or is it different depending on the asset?
In terms of materiality, right? So depending on the company and depending on its context that it's operating in. So for example, an oil and gas major is going to be very different to an information technology company in terms of what is material. And of course, some of those materiality factors can just be on the E, S, and G side. Now, I suppose, from our perspective, we don't necessarily give any strong guidance. We will measure items across all ES and G. It's just that, of course, where we have an ESG rating, that ESG rating, some parts of will be driving others. For example, we'll have a controversies database, and if there's a supply chain issue in terms of labor rights, that which is very recent, that may mark them down more than, let's say, an issue relating to their carbon climate transition plan to 2050, just because of the time horizon involved.
It does sound like again, I apologize for what's sort of an elementary question, perhaps from your perspective, but it does sound like you keep tethering this to the credit, which makes sense, but the risk of the investment as opposed to the impact of the investment, right? I mean, which is that fair that you're staying sort of grounded in this, we measure the credit risk of this, we measure the long-term ability to repay, the terms as set forth in the initial deal, and you sort of you're saying tethered to that, it sounds like, at the moment, as opposed to just saying, well, maybe completely sustained, like, from a credit perspective, this thing may go on forever, but it's completely damaging to an environment over here. Does that make sense?
I think that's important from a rating agency perspective. I mean, we are evaluating credit risk here, and what we are trying to do is we're trying to incorporate some assessment of the ESG factors in that credit evaluation. So, you may have a situation where it may be very positive from an ESG perspective. So giving, great ESG credit if from a sustainable or ESG evaluator, but from a credit perspective, it may actually be a negative. And so as a result, that could have a negative influence on the credit rating, but it may not necessarily be positive from an ESG perspective. Now, an investor is going to have to look at that and go, okay, well, we really like this asset because it does have a positive ESG impact, but you know what? It's going to cost us because it's going to have a negative credit risk perspective that needs to be incorporated into that evaluation as an investor.
Or vice versa.
Yeah, and I would
absolutely. Yeah,
I would just follow on from what Gordon actually said. From a not speaking from the Moody's Investor Services, who I believe there'll be someone speaking tomorrow, we will look at both the risks and opportunities, right? So, for example, in terms of like VE, can look at, to give you an example, let's say you've got an energy company in Europe that is aggressively trying to beat the decarbonization plan for their country, and so as a result, they bring forward the years for carbon neutrality by 3-4 years. Now, it's much more than they are expected to do, which is positive on an ESG perspective. But having said that, there is an additional incremental cost, which is the credit implication. So the stakeholder being the globe, the carbon budget of the globe is rated positively because of that's on the environmental side. But then, of course, there is a transmission risk of that activity, which has come through as a financial materiality side, which will be addressed probably in terms of a credit analysis, let's say.
Yes, that makes sense.
Yeah, Karen.
No, please.
Yeah, no, and I think that's the key distinguishing point for like an agency like VE, for example, or even versus a rating agency. The rating agency, a rating agency analysis is looking at, what are, it's a very particular analysis in terms of, repayment ability, whereas the ESG ratings outside of that, VE is a little bit more broader. So they look at risks and opportunities. So there's a little bit of the equity analysis there in terms of the opportunities, but they also look at, which is unique to VE, stakeholders as well. So it's not just the company, it's the stakeholders, which includes, for example, even like compensation programs of employees, not just the senior suite.
Interesting. So, okay, so if you're an investor and your interest is in making sure your investments are in things that are good for the globe, as well as can meet the index, or let's say you're an asset manager selling an investment that says we can meet or beat the index and be good for the globe. The credit rating input process is one subset of that, but that's going to be largely focused on the, it's still here's some factors that enhance our ability to rate this issuer's ability to repay these terms. It may or may not be this. That probably is going to actually have some differences, it sounds like, between that and the metrics that an asset manager would use to determine that these investments meet the criteria requested by their clients. Okay, so that's an interesting distinction. So, but on that, I mean, even though you're looking at the credit piece itself, you surely have some visibility into the evolution of this market overall. What are some of the things driving these astronomically high numbers that we're seeing in terms of investor demand for sustainable investments and all that? Is it, some of it I know in Europe is regulation. I think in the US it's a little bit more the ratio of regulatory mandate versus investor demand is a little bit more on the investor demand side, I think. That's kind of the sense that I'm getting, but we'd love to get both of your thoughts. We can start with whoever wants to go.
Yeah, I think if we, you're right. We've seen a very strong growth in terms of investor interest in ESG factors, and I think it's something that's been bubbling along for a while, and it's now just starting to really accelerate. And that acceleration there is an element of regulation that's driving it, but it's not just the regulation that's driving it. There's been, if you take the example of the PRI, it has been signing up investors to this view of sustainable investing for a while now, and and that's not been regulatory driven. That's their personal interest in being involved in this movement, if you like. It's been helped, I would argue, by low rates. It offers an opportunity for ESG to prove itself as a valid investment, and people are starting to look a little bit longer term rather than sort of thinking about just the next, next quarter, next year, and yeah, there is regulation that is starting to push forward, coming out of the EU. You're right. EU taxonomy was just launched this year. They've got an action plan in place in terms of spurring on sustainable finance. But even ahead of it actually being in place, there are funds flowing into sustainable funds in Europe and in the US. At the moment, Europe seems to be the leader, but I can guarantee you that the US certainly has the capacity to pick up very, very quickly and easily surpass the amount of money that's being pointed in this direction currently.
And
Yeah.
go ahead.
Sorry,
Go ahead.
Michael. Yeah, no. I would just say that you know, it's what we would see as well, right? In terms of this market started off being very values driven, coming from the equities space in the 90s, which was a little bit more on the screening side. Then what we've effectively come to see is that, you know, it started off particularly in the fixed income space with the green bonds, started off with the supranationals. It was very much as a way of showcasing environmental credentials, like normally best in class, really, that we were seeing. And then what's happened really also, and again, just to reiterate what Gordon said about the low rates, on the asset management side, there's been a particular squeeze, not just on the low rates, but also the switch to passive. Now, if the pickup in terms of ESG linked, which taps into, let's say, pockets of passive demand, you know, we're tending to find that the AUM fees is about 10-15 bips higher when it's got an ESG label onside it, right? So there is an asset raising aspect to it, which is pushing the asset managers to like move into this space a little bit more aggressively, particularly in certain regions within Europe, for example. And so we're like seeing that, and then of course one of that is marketing. But the other aspect is, and of course, you know, coronavirus has been a big wake-up call this year. It's sort of the abnormal, right? Which is, you know, certain risks that are not routinely considered in financial accounts can actually manifest into risks as well as opportunities. And of course, that catalyst has moved interest into this, not just being about regulation, which was initially the big driver. For example, the Chinese market started off fully regulatory driven and is still largely top-down derived. But it started off issuer based, but now it's becoming investor interest, because there's ultimately some belief that you can find alpha if you're positioned well on the right side of some of these risk factors, and you can mitigate it on some of these what we call non-traditional risk factors, which is these ESG factors that we're talking about.
And the UN Paris Agreement and UN Sustainable Goals initiatives, these things, have they been driver in the EU for the development of this market? And how now, you know, in the US we're switching administrations. The US has been overtly, I would say, hostile to these agreements over the last few years, but that'll probably change. So curious if you think that increases, you know, investment interest in these products.
I would take that sort of twofold. There is an element of that, you know, the Paris Agreement and the sort of the global governments making those agreements, moving that down into things like the European Commission and their action plan with regards to sustainable. Actually, they've recently changed it to the Green Deal. Sorry, that's the proper term. And so they are working the concept that they've taken from that higher level. They're working that into more and more regulations. And so it's not just about, you know, driving sustainable finance or investment finance. It's also about everything from battery regulations that recently came out yesterday or debated yesterday with regards to Europe, and a number of countries announcing that they are going to stop petrol and diesel vehicle sales beyond a certain date. You know, these are sort of other initiatives that then filters down into the funding side of things. So we need to find a funding solution for that, and as a result, you end up with some of this investment dollars being driven both from the pull side as well as from the push side. As the sort of, it's not just the immediate regulation of ESMA coming and saying that we need to make sure that, the European Securities Market Association, saying that we need to start investing into sustainable finance. There's regulations being driven in lots of different places that are helping to drive that movement forward.
Okay, so that's interesting. Now, it does strike me that for 25 minutes we've been talking about this, and it's mostly been of the ESG. It sounds like. So let's talk about some of the other factors. Governance. Would love to hear your thoughts on how those factors are looked at, and then social justice investing. I think is something that, given the tragic events in the U.S. this past summer, that unfortunately aren't new events, but the attention it grew to the social justice movements and the importance of things like the racial gap in access to housing and access to credit and access to financing, etc. Is this now, in your view, something that will be a bigger driver of the ESG certification and sustainable investment certification or factors than it has been in the past? And what are some of the things in the S and the G space that we ought to talk about and understand that are driving decisions and metrics?
I suppose, from our side, governance feeds both environmental and social factors, right? So the thing is that the independence of the board, the tenure of the board, how frequently they're being turned over or not, as the case may be. Certain jurisdictions, this gives us an indication in terms of conflicts of interest. Also, board diversity. Now, board diversity sounds something that is quite straightforward. It's only straightforward when it's reported. For example, gender diversity. If we use two genders, is a little bit more straightforward than, let's say, ethnic diversity. But then, of course, if they're not disclosing this information, it's quite hard for us to do, despite that there are academic articles out there which talk about correlation. It's also still quite hard to find the transmission channel for where that would be performance or not. And again, the question is whether, and that's the whole integrated part, whether it should be just performance we're talking about, or is it this so-called triple bottom line, which is actually, no, this is just the right thing to do. It's a value-driven thing. Now, of course, you mentioned there, Michael, about the social justice and things like this. That there are increasingly normally on the equity side in terms of engagement. So there's a lot more that we're seeing. Still not substantial, but it's certainly an increase from a low base in terms of a lot more shareholder resolutions and proxy voting, which is sort of looking to address that and at least have companies align on that basis. Again, there's been a lot of company information out there, but the unfortunate thing is, and it's a little bit controversial to say, but a lot of the ESG reports that we see is more marketing than substance, right? So the thing is that they're not, the data isn't comparable. They're literally released in different ways, and so although they tend to be flattering, the usefulness of it in terms of understanding how that can be used in sustainable finance as a what I call an intelligent data as opposed to just big data, and it's just information, still needs to be seen.
That sounds frustrating but accurate to me. I mean, not frustrating. It's an opportunity. I do think it's an opportunity. I just think that it highlights the magnitude of the challenge, right? So is this really a turning point in the way investors in a world that's got 7+ billion people, that is clearly past the tipping point in environmental sustainability, that is clearly, I hope, past the tipping point in terms of racial inequality and wealth inequality and these social justice factors that are not sustainable at the trajectory that they're on? And we're now finally going to say, as the allocators of capital in this globe, we're going to come up with some concrete, but I should say clear, but evolving and dynamic set of criteria to make sure that we're investing in a way that humanity can survive. Is this finally that moment, or is this just the next window dressing iteration of the process of saying, hey, you can feel better about yourself if you give me your money? What do you think?
Go ahead, Aaron.
Oh, all right. Yeah. No. No. I think that it's a little bit different, right? There's a lot more going. There's a lot more driving this. I mean, we're seeing intergenerational transfers of wealth into a generation that consider these factors more important. That's also pushing, let's say, democratic norms in order to regulate these things. So there are what we call transition risks and transition opportunities. To the extent that governments control the law of the game, and to the extent that that can be put in place in the market, what we're going to find is any negative externalities or even positive externalities will start being internalized by various either regimes in terms of laws that require a company to convey, or even business model changes, for example, with the extraction of, let's say, tar sands and things like this. So which brings us on to stranded assets and things where effectively there is a lot of intangibles, and the question is whether those intangibles can become tangible in the end. So there is that element, to the extent that the horizon also is a little bit longer term. This is something to be considered. A lot of the sustainability or ESG factors, it's not trading data. This is not data necessarily that you move in and out very quickly. A lot of these are thematics, they're themes, they're structural changes in the way the globe operates in order to, as you mentioned, Michael, to recompensate the fact that we're sort of, the world is beyond a sort of tipping point again. It's also a use of language as well. The way we use tipping points can be borrowed from, let's say, climate models, and of course there's still probabilities, but that depends on the stakeholder that you're talking to as well. Depends on whether we'd say, let's say, it's a climate change risk or it's a climate risk, for example.
Just to add on to that, I think that these are, you will start to see more action. You will start to see more proxy voting that will maybe controversial as we move forward. But these people are signing up to behave in a certain way with regards to their investments. And I think that will start to drive some change. Now, whether or not that's enough remains to be seen. But when we look at things from a social and a governance side of things, investors are going to start to hold these boards to some degree of account, or at least more than they have in the past. Now, whether or not that's enough, because you start to become, there's a danger that you become political as well. So you then end up with investments becoming more political than they necessarily maybe feel comfortable with. But at the same time, they are agreeing to these sort of norms. And I think when we look at ourselves as a company, you can see change happening within our own firm and things that are migrating in a positive direction. And I think we've always been in a very good position to defend our social and governance side of things, but that is evolving even further, and you can sort of see that happening throughout the company. And as a publicly listed company, on top of that, we also have somebody else who's a part of the broader Morningstar family, sustainability, who's also there to hold our feet to the fire as well. We're not up to standard.
I mean, a case for optimism, maybe. We want to be optimistic around here. We suffer from infectious optimism. Sometimes that is a good thing, sometimes it's a bad thing, but I'd like to make the case for optimism. I mean, if it really, I believe you, and in that this investor demand driver is here and it's not going anywhere. And I think that's real. And I think that what that does is that creates an enormous amount of energy for people to figure out how to iterate on what this means and what this is. And so certainly the rating agencies clearly have this role to play and in integrating these factors into the credit rating decision, and that gets this conversation flowing and everything. But then investors are going to have, and they do have this role that they seem willing to play to say, let me market these things and get better at publishing the criteria. And then I think you're probably going to have institutions that want to come up with new ideas to say, hey, we've got this approach to debt issuance and to lending that takes into account these factors over here that maybe a lot of ESG and sustainable investing watchers aren't taking into account. We think they're important, and so let me put that on the table for you as a rating agency or as an investor to consider. And you get the competitive forces of trying to market things that actually do have good impact, can lead to some pretty good outcomes. And I think it's really just probably a process of us capturing sort of that energy and then making sure that what we're doing right now, which is take everybody down the table and say, well, then show me your work, show me your metrics, show me your criteria, and this thing will evolve and grow, but show me the work product. And maybe that's the way we get to where we need to be.
Yeah. I mean, I suppose you're right. It's really a case that previously we would have indices which started off with SRI, ESG, various themes also, and again the inflows is pretty incredible this year versus, let's say, the non-thematic labels. But also companies which have, or even banks which have created a huge amount of, let's say, sustainability frameworks which back the commitments that they make. If we go back a decade, a bank could make a commitment to say, we want to do increased lending in X, but now people are saying, well, how credible is that, and where is the framework? And so there's a whole now frameworks being put in place that's being reviewed by second-party opinion providers, very akin to how green bonds and social bonds are put together. And of course, that framework is then ultimately allocating, let's say it's an amount of lending product that is then being brought in and then passed out into their CSR reporting, which of course, then they will have a dialogue with their investors of what that means, whether it's, again, a value driven, whether it's good business or something else. But, there's an increase in data that's being available. The question is many investors don't know what to do with that data. Small asset managers, we find, tend to have one or two ESG data providers. The biggest asset managers can have 8 or 9 with also analytics inbuilt, and they pipe all the APIs, and then they can come up with their own opinion very mechanically. And so again, that's just a sign of the market's maturity of dealing with this. There's so many different ways of dealing with it at the moment, even analyzing the risks or opportunities. But again, as people become more familiar, it won't just be a specialist niche area, it will go more mainstream. So it won't just be an ESG person, it will be a credit and ESG person, for example.
That makes sense.
That sort of the money being put into this sector will also drive, it is driving that demand for data and for information, as Aaron was just pointing out, and that then filters through to people like us, who eventually then we can, as we get more evidence to suggest that this sort of behavior leads to positive credit result, then we can start to put that into the actual credit evaluation, or play a larger role in that credit evaluation.
Interesting. So we have a few minutes left, and there are a couple audience questions that I think are relevant and pertinent to what we've been discussing. I'll start with the second one that came in. So I'll read it verbatim. Is regulatory edict the best way to accomplish these goals? For instance, auto transition to EV when EV is multiples of cost of combustion engines. Doesn't that create further class stratification?
Class stratification in terms of autos.
Cost of, I would imagine it relates to the cost of
the sustainable cost, how you evaluate whether or not an electric vehicle is more. I mean, the answer to that is yes and no. I mean, the regulations are going to drive these differentiations. They may be driven by perhaps misaligned objectives, but I mean, when we look at it from the finance world and the finance perspective, with regards to those types of regulations, we are we're a taker of that view, and then we need to evaluate it ourselves in terms of the way that it works. For
Yeah.
example, to bring us back to the structured finance world, if we were to look at an auto transaction, is it electric vehicle or is it petrol or diesel? Well, then you may incorporate those sort of, you're not going to incorporate as far back as the actual production. You're going to incorporate what's the value of that vehicle, and is that vehicle a clean or non-clean vehicle, and incorporate that into your analysis, and whether or not there's a value difference as well.
Right. I'm not sure that we were saying regulatory edict is the way to do it, but like, I don't think that's what we're arguing. I think the regulation has a role to play in standardization of data and transparency. In Europe, it sounds like it has a role to play. Some mandates for investment, but a lot of this is being driven by investor preferences.
Yeah, I mean, I would just, reiterate again what Gordon said there, in terms of, if we go back just 15 years, solar cells were not competitive with conventional utilities, at least on a levelized cost of energy perspective. And technology is evolving quite significantly. And where you have regulatory hard caps, so for example, if by 2030 there are some European countries which outlaw or ban the sale of new petrol and combustion like engines, that's going to have a massive impact on the secondary market for those vehicles. And it's something that Gordon mentioned that, like a rating analysis would look at. And it's also something where we would say, if anything, a regulator will catalyze it. But of course, again, a lot of this is, governments are beginning to trying to internalize negative externalities. This previously, whether it's via a combustion engine ban or whether it's via a cap and trade emissions scale, there are many ways ultimately to get us there. And of course, again, we're not looking at it from today, we're looking at it from the future. And to the extent that EV vehicles are more expensive today, I mean, it depends on the discount rates that we're having. Discount rates will be a lot higher to the extent that we're going forward when we're looking at, like, let's say, climate horizons, which is 2050 plus.
Interesting. All right, I think that makes perfect sense. So I think we have time for maybe one last audience question, and this may be an interesting one. I don't know if you guys thought about legacy deals that are currently, have been issued in the past, trading in the secondary market. The question is, how should we think about ESG in the secondary market for older deals that were issued prior to the more recent focus on ESG? What, if anything, can be done to make this large piece of the market more ESG sensitive? And I think generally, just, is there anything on legacy deals that we, can bring them into the ESG framework, or is that just sunk and it's a separate piece of the market?
I don't think it's sunk. I think you have plenty of verifiers out there, like people like Sustainalytics or other providers that can help to either approve it as meeting the standards, the green bond standards, and of course the issuer themselves may, if they do think that they could meet those standards and it would make their investment, or actually you could even have it driven by the investor. If the investor goes to the issuer and says, listen, it'd be really great if you could make this a green bond, happy to pay up to help get it certified. I don't see why that wouldn't be feasible, and I don't see why issuers wouldn't be interested in doing that. I think at the moment it's an element of time and demand. And if investors are willing to do that, if we take the example, bringing it back home to the structured finance world, I mean, structured finance has been a part of some ESG positive developments, particularly in the U.S. with solar bonds and PACE as well. One of the first electric vehicle auto transactions was done out of the U.S. So, I mean, there is certainly plenty of scope for that to happen in the future. I don't see any hindrance to that occurring.
That's great. That makes sense as well. We could clearly continue for a very long time, but we are at time and want to give everybody a chance to log off and log on to the next session. Aaron and Gordon, thank you very much for joining us. If audience members have follow-up things that they want from your firm and such, I'm happy to facilitate, getting questions and such to you. But it's been really insightful and helpful. And please help yourself to the rest of our sessions and enjoy the day. And thanks for your time.
Thank you very much, Michael.
Thank you very much.